Hello friends, welcome back to the channel. Today's video I am going to share some ideas with you which will make you a lot more smarter with money. These are some hacks, some ideas that you can use and implement in your financial life, and you can start applying these immediately. Let me start. I'm going to share 7 such ideas with you today. Before we start, if you have any other idea that you think that is better than what I have shared, why don't you comment and tell me? So let's begin. First one is the percentage rule. Okay, this is a rule that I personally use, right? Whenever I have to spend money, I use this formula to figure out if I should be thinking too much about spending this money or not. I recently even wrote a tweet about it. I'm sharing that on the screen here. So the percentage rule is such that whenever I have to spend money, I use my net worth as my benchmark to spend money. Okay, so for example, if I have to if the expense is 0.001% of my net worth, then I don't have to think twice about spending this money. Then if the expense is 0.1% of my net worth, if I do it a few times a year, it's not going to change my life or impact my net worth as such. So I can go and spend it. But if the expense is 1% of my net worth, then what I have to do is I have to deliberately think about it and make sure that the expense decision that I am making is well thought about, right? So let us take an example and understand how it works. So if you can see the screen, if the net worth is say 1 crore rupees for example, okay, and the expenses of 0.01%, which is 1000 rupees or thereabouts, I don't really have to think too much about it. I can spend this money. Just to have to make sure that you don't do it hundreds of times, right? Then obviously it will not make sense. Then if it is 0.1%, 10,000 rupees, then you could do it say 3-4 times in a year or 5 to 8 times in a year. You are still okay. It's not going to change a lot of things, right? But if it is 1% of your net worth, which is 1 lakh rupees, then you have to be deliberate about it. Always think about it and do it. But ideally, how I use this rule is, even though I use the net worth rule, I ensure that my income is enough to income is enough and it's able to support these expenses, right? When I say income from the active work that I do and not from my portfolio, right? So that becomes the interesting part here. Now let us move on to the second rule. The second rule is the 3x rule that I use. Okay, so now one more important factor in. So like I told you, the 1% rule there where I have to think deliberately, right? So here also in this 3x rule, basically the idea is that if anything I have to buy, okay, let us take an example that I have to buy an iPhone of 80,000 rupees, okay. So I have to see whether my income and my net worth, will it be able to afford, will I be able to afford buying 3 iPhones at a time today? If I can do that, then I will go ahead and buy this iPhone, otherwise not. So this can be applied to a lot of the bigger expenses that you have in your life. Say for example, buying a car, TV, all the discretionary purchases, taking holidays. So that's when it becomes very easy for you to make those big purchases. This may not be applicable to buying a house because the calculations are quite different there. So if you want me to do another video on how to think about buying a house, why don't you comment and tell me, and I will make a video about that as well. Let's move on to the third rule. Third rule is one of my favorites, which is not interrupting compounding in tax-free instruments like public provident fund and employees provident fund. You have to understand, folks, that these are one of the best investment options that are available in the fixed income space for us as Indian citizens. Public provident fund currently as of today gives you around 7.1% interest, which is tax free. The maximum amount that you can invest in this is 1.5 lakh rupees per annum, and you can do it in all adults in the family in all their accounts. Apart from that, employees provident fund it depends on the contributions that you make from your employer and employee contributions from your salary. This gives you 8.1% interest every year, which is also tax free. There are certain limits on this. I will share some other videos I've done on this in the description box below and also here. You should take a look at those videos. So the idea is that the income that gets generated on these investments are tax free completely. Say for example, if you have 4 people in the family and 4 adults are there, what you can do is you can contribute 1.5 lakh rupees in each account. In public provident fund 6 lakh rupees. In 10 years, what happens is you will have accumulated 60 lakh rupees in a total, total in all the 4 accounts, and you will get 4.2 lakh rupees tax free income, okay, which is massive, right? Because compounding helps like this. And then so PPF account does not have any sort of maturity. That is also amazing, right? So you can continue to hold your PPF account for the rest of your life as well. So I've done a specific video on PPF as well. You should take a look at that. But PPF and EPF are awesome instruments and I really love them, right? Let's move on to the next one, which is credit card debt versus personal loans, right? Say for example, I have noted a lot of people taking credit card debt, which is extremely bad. What does credit card debt mean? Credit card debt simply means that not paying your credit card dues on time and paying it in, making the minimum payment due and paying it later. So what happens is when you don't pay on time, interest gets charged on the unpaid amount. Okay, when this interest is charged, charged at very high rates, somewhere between 36% to 48%. So if you're unable to pay the credit card debt, why should pay the interest at such high rates and borrow the money? Why don't you go out and take a personal loan from a bank or from any other NBFC and then use that money to pay off this credit card debt, and then that personal loan will charge you around 14%, and you can then pay off the personal loan. Okay, only caveat is that the credit card debt does not have any sort of pre payment charges, but the personal loan could have. What else you could do is, there's one more hack here. See, if you're unable to pay your credit card bill, right? Just call the credit card company and tell them to convert your outstanding into an EMI. What happens is when they do that, this will be charged at a lower interest rate versus you not talking to them and just not paying the bill, right? So this becomes a very important. So let us move on to the next and the fifth hack now. Fifth hack is keeping money in savings bank account and fixed deposits when you are in the maximum tax bracket. Say you are in the 30% tax bracket and above. If you earn more than 50 lakh rupees in a year, you surcharge is also payable. So technically you end up in more than 40% tax brackets also. So it is a very bad idea to keep a lot of money in savings bank account and fixed deposits, right? Keep the minimum amount possible and move it to a mutual fund. Even if you move it to a liquid fund, what happens is if you keep it for 3 years, then the debt long-term capital gains taxation gets triggered and the indexation benefit is what you get. So what happens here is then the net tax rate, effective tax rate comes down. So for example, you invested 1 lakh rupees today in a liquid fund and in 3 years it grew to 120 rupees. So now what is going to happen is when you are going to sell this and realize the profits, when you are going to pay tax, the tax will be calculated on the indexed cost. So your 1 lakh rupees will be indexed based on inflation. Let us take an example that 1 lakh is indexed to 1,15,000. So your tax liability will be on the balance 5,000 rupees only. So 20% on 5,000 is going to be 1,000 only, versus in a fixed deposit, whatever 20,000 rupees you earn, you will have to pay a tax of 6,000 rupees on that, right? So this is the massive difference, and you have to be very careful. If you're a high earner, if you keep a lot of cash in your bank account and fixed deposits, don't do it, move it to mutual funds. You will be in a much better position. Okay, now let's move on to the next hack. Okay, this is again one of my favorite hacks. So if you spend anywhere between more than 50,000 rupees in a month, okay, ideally you should be using the right credit cards and you should be taking credit card rewards. You can get a minimum of 2 to 3% rewards easily, okay, and on the upside it can even go to 12 to 15% provided you use the right set of cards. So generally for us the expenses are on the higher side, so I use a whole lot of credit cards that I'm going to show you now. These are all the cards that I have as of today. I have done lots of videos on the credit card strategy. Idea is that you maximize. Why should you, when you are spending money, some expenses are inevitable, right? Be on the higher side or lower side, doesn't matter. So some expenses are inevitable. So when you're spending money, why should you not use cards and get some returns from that and make your holidays free, right? So I am sharing this video. This is my latest credit card strategy that I am following. Take a look. I'm adding the link here. It's very important. Lots of people have benefited from this. You should also take a look. Last one is the savings rate concept, right? So since savings rate concept is a very simple concept and also a very smart concept. What it means is how much are you saving on your total income every month. Say for example, you are earning 1 lakh rupees and saving 25,000 rupees on that every month. Your savings rate is 25%. Now when you save 25%, what it means that you need 3 months to save 1 month worth of expenses, because you are spending 75,000. So to save 75,000, you will need 3 months, right? So the higher your savings rate, the lower will be the number of, the lower will be the time required to save the money for 1 month worth of expenses, and faster you will reach your financial freedom. So now let's take example that your savings rate is 50%. What does it mean? Every month you are saving 30 days worth of expenses. So in 10 years, you will save 10 years worth of expenses. And if your savings rate is 75%, this means that every month you are saving 3 years worth of expenses, 3 months worth of expenses, sorry. So in 10 years, you will save 30 years worth of expenses, okay. That's why I say, I have been emphasizing a lot about this. Always have a high savings rate. High savings rate will help you achieve your financial freedom very quickly, right? I hope you enjoyed this video. Any comments, why don't you hit the comment button and let me know. If you have any other hacks, let us discuss, and maybe I'll make a video on that and also give you the due credit. Thank you for watching so far. If you have, why don't you share it with your friends and family members, and do not forget to like, share, subscribe as well. Thank you.